if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside.
Today's gold and stock markets look like a ghost of 2007. Back then, gold surged 37%, while the S&P 500 fell 20%. Now, chart patterns suggest gold could run toward $4,500. This is a rare setup that could trigger a very fast, powerful rally, especially if equities roll over. Since the start of 2025, spot gold has climbed 40%, setting 26 new highs in the first half alone, on top of 40 records in 2024, according to the World Gold Council. Gold futures have reached new highs, but the gold ETF, GLD, has yet to confirm the move. Veteran market analyst Chris Vermeulen states a close above key levels would spark a real breakout that spills over into silver and mining stocks. Savvy investors are taking physical gold deliveries on COMEX. The COMEX gold futures market has experienced an unprecedented surge in physical gold deliveries throughout 2023 and 2024. According to market analysis, January 2024 saw delivery volumes exceed normal levels by over 300%. While June briefly returned to the previous year's levels, July quickly reverted to elevated demand, with over 3 times the normal delivery volumes. Silver is prone to sharp moves, and while it could reach $50 in the short term, its volatility makes it a difficult trade to catch. The silver bull market thesis is built on fundamental supply-demand imbalances that appear likely to persist and intensify. The scarcity of primary silver producers, combined with growing industrial demand and potential monetary system pressures, creates a setup that could deliver sustained outperformance relative to other commodity sectors. However, Chris Vermeulen believes the gold chart is screaming, a clear warning that money is flowing out of stocks and real estate. Concurrently, Vermeulen cautions that miners, being tied to the stock market, suffer from broader equity sell-offs. He expects miners to shine later, likely after a major financial reset. Before we dive into Chris Vermeulen's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
You and I brought up this comparison chart of the S&P 500 in gold. Gold's the yellow line. This is 2007. The right-hand chart is where we are right now.
Right.
We've got the S&P 500. You and I brought this up last time we spoke a few months ago, and I talked about how this type of scenario, gold actually had an upside move, a measured move in 2007, just as the stock market was putting in a significant top, which I think is close to where we're at right now. Gold should have rallied 20%. Not only did it rally 20%, but it blew past it and went up 37%. And so right now we have a very similar chart pattern. Gold, if we flip back to the chart of gold, has this, I love to use Fibonacci extension, Fibonacci theory. If you don't know it, you have to look into it because it's in everything in the universe. But more or less, it tells us where the upside targets are. Now, based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. If we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside. And if you compare what happened in 2007, if we were to just scroll forward,
Right.
we saw the stock market fall 20%, and we saw gold shoot up 37%. And I believe we could see something similar. If we were to fast forward this, we would see, the stock market potentially top out and start to sell off, and gold just keeps going higher and takes off. So that's an opportunity. This is a very rare type of setup that's unfolding. And I think one of the key things for, short-term traders is if we look at the price of gold futures here, and I think this is very important for people to understand, is gold did break to some new all-time highs on the futures market, but that's not what I follow when it comes to trading gold for a trade. I like to look at any gold, physical gold ETF, GLD or whatever. If we zoom in on the chart price action, you can see we never did hit new all-time highs back when futures did. So I'm really looking for gold to break above, when GLD closes above 1750 more or less, I'll be like, okay, you know what? This is it. This bull flag is breaking out, and probably we got chaos in the stock market. This will be kind of that play for gold. So gold has got huge upside potential. And I think it'll bleed over to silver and miners as well. So silver is wild. It has a very ugly chart. It has a lot of noise, huge pops and drops, big rallies, big sell-offs. It's definitely more volatile. And I think that has to do with silver is a lot more of a speculative play. It's a smaller market, so it moves faster. Gold I like because it's kind of the global barometer. It's the whole world gets nervous. When gold moves up, it means globally there's weakness and people around the world are seeing something bad happening on the horizon. And that's what the big chart of gold is pointing to, is we're on the tip of something hitting the news, something that's going to change everything. I think that's what gold is warning us. But silver does have upside potential. I mean, it's in an uptrend. I think it could rally to short-term wise. The next upside target short-term is about $40.75. Not that high from where it is. But as you know, silver, when it does take off, it kind of just shoots and goes ballistic. If we were to zoom way out on the chart, it can have these massive explosive moves. And it's really tough to gauge. Silver moves very quickly. If you blink, you can miss it. You kind of have to be sometimes just positioned in it and stomach the volatility. And then if that hits, then you're a part of it. But a lot of times some of these moves happen in 1 or 2 days, some of these big pops and drops. But when we look back on this chart, there is potential, though. We see gold shoot higher and silver could go up and tag that, all-time high of $50. It could spike up to that level. It would probably do similar to what we saw back in 2007. We saw silver. Let's just zoom in on that price action. In 2007, we saw, just as the stock market really started to sell off, we saw silver shoot higher. Percentage-wise, on average, it moved up about 20% or so. And interestingly enough, the chart pattern for gold and silver right now, Daniela, is gold actually has more upside potential. It's the opposite of what you think. It's the opposite of what everyone else thinks. They naturally go to silver for the bigger gains. But for some reason, all of my chart patterns for silver, and even when you compare what happened kind of back over here, it has the same or less potential for some reason based on technical analysis than gold. So I like gold because it's stable and I think it's going to be a big move. But we'll just have to see how this unfolds. Obviously, silver, if we were to go back, silver did have a pretty massive run from these lows. It was roughly the same, about 40% or more from like what gold did. Gold did about 37 as it broke and shot higher. Silver also did about 37, somewhat from the same time frame. So you kind of pick your poison, spread your money between both. The gold miners they're doing well. They're outperforming gold. I mean, they have pushed up to some multi-year highs, while gold has just been flatlined sideways. That is a good sign. And silver miners have been doing the same thing. If we see gold miners leading the price of gold, it usually means gold will break out soon. And then usually we're going to see a very nice move in the whole precious metals space. Now, here's one of the other things. A lot of people want to move into miners to make more money, percentage-wise, just like they think silver has more upside. And while it may, if you go back and look at 2007 market top, gold had the biggest percentage move with the least amount of noise. Miners, because they're stuck in the stock market, when the stock market tide goes down, when there's mass selling in the stock market, because miners are stuck in the stock market, they do have selling pressure pulling on them. So they don't just float up and skyrocket and shoot higher like the beginning of a new bull market. They hold their ground and they grind their way higher, but they just don't take off like most people, I think, want them to. Gold is actually that better play. Silver is kind of the better play. Both of them outperformed miners in this particular scenario. Now, I think there's going to be a good time for miners. After we have some financial reset, I think miners will be the ultimate play for some huge moves. But that could be 6 months, 12 months, 2 years away before we go through a whole cycle and everything resets. So
Right now, the global economy is emerging from a period of high inflation and elevated interest rates. Central banks are reducing interest rates, with more cuts expected, which will encourage household spending and business investment. The stock market's strength is a dangerous illusion, propped up by the Magnificent Seven, while the broader market shows weakness. Chris Vermeulen warns this masks a looming crisis that could send the market falling 20% back to last year's lows. He argues investors must have a plan, as gold, silver, and miners are flashing strong technical setups that could thrive in a downturn. Buffett continued to sell more stock than he bought last quarter, trimming more Apple and Bank of America. The sales occur amid a low corporate tax environment and high market valuations. Warren Buffett may be cashing in stocks because he sees a storm on the horizon and could buy them back once prices tumble, a senior market strategist says. As Buffett rotates away from tech giants like Apple toward more diversified sectors, does this signal broader caution for investors? Let's get back to the interview.
we're definitely at a huge point in the economy where I think we could still see the stock market rally higher for a little while. I think the market is trying to. The Magnificent Seven is doing most of the heavy lifting, although in the last couple of days we've seen some big selling in the Mag 7. I think going into the news of Jackson Hole, people are getting nervous about big tech. But overall, the Magnificent Seven have been dragging the stock market higher. And if you kind of peel back the layer of the Magnificent Seven and look at the general market, I like to look at RSP, which is an ETF. It's equal weighted S&P 500. I like to look at the Russell 2000, which is IWM, and the IWC, which are the micro caps. And if you put those three tickers together and see the combined price action, it's kind of the broad market. It's large, small, and micro caps. And really, we're putting in what could be a major double top. So most stocks have been struggling. Magnificent Seven put what I call camouflage. They drag the major indices higher, making everyone think the markets are strong. But underneath the hood, a lot of stocks are struggling. They're putting in major tops or hitting resistance levels. And so I do think we could see a huge collapse at any point. We just need some tipping point, some piece of data that could turn the tide and change things around. But right now the markets are, they're still trending up and they're trying to push and grind their way higher. And if we take a look at, let's pull up 2025 and 2024. So this is the QQQ. So the NASDAQ 100, the top chart is more or less where we are. I drew this a little while ago. We're testing up right near the highs a few days later. But overall, we had a big sell-off. This was the low in April this year, as you just talked about, Daniela. Well, if you go back to 2024, we also had a sell-off in a market low in April. We also had this huge extended run last year. And here we are, almost a similar pattern where the market is struggling. And it pulled back last time to the lows of April, which was a 15% drop. And this time around, if the market does roll over here, we can see a very simple repeat where the market drops back to the April lows. That's a good 20+% haircut in price. I'm not saying this is going to happen, but it's funny how the markets are kind of repeating themselves. We're on the cusp of some big news. The markets are not very strong. They're getting driven by the Magnificent Seven. But overall, that's kind of an interesting scenario that's unfolding. I think people need to have a strategy in place. Now, we're still long the equities market, but overall, you have to have a strategy because if this does roll over, you want to make sure you get out. You do not want to ride that down. You want to probably benefit, move to something that will go up. And some of the things setting up for some big moves are gold, silver, and the miners. And we're positioned in some of those because I think they've got some big chart patterns. So that's kind of the take of the cusp of where we're at. But the markets, as you know, always have a way of kind of grinding and pushing higher and sucking people in before it rolls off a cliff. So we just have to see how that is going to unfold going forward.
Right.
I think the recent sell-off, obviously this was, you and I talked a few days earlier, so I don't know what the price action is in the last few days, but what we're seeing right now, as you and I are speaking, is I think the Fed decision is starting to get baked into the price. People are selling, they're fearful. They're talking about Magnificent Seven, big techs having huge headwinds. And so that's exactly what we're seeing. If we look on the left-hand side of this chart over here, we got the Mag 7. This is the majority of the market. You can see it's getting sold off with heavy volume. And so I do think it's getting baked into the cake and sell into, people are selling, they're fearful. And then the news is going to come out and people always, as you know, try to front run. They try to beat the news or do what they think is going to happen. And even if bad news comes out, a lot of times we see things rally. It's always the opposite. Trading news is very difficult, as you know. Nvidia, for example, great example, not only meets earnings, but exceed earnings dramatically, but they don't break it by enough, and Nvidia falls, even though it was stellar reports earlier, last year and stuff like that. So you never know. Good news usually gets sold into. Bad news, it's already usually sold going into the news, like right now, and then it gets bought. Bad news gets bought into. So it's always a crapshoot, and really you just have to sit back, let the market do what it's going to do. Make sure you have a strategy to identify, hey, has the trend actually broken? Do we need to get out? Or is this just noise leading up to news and it's just the market trying to shake things up?
The dramatic increase suggests a fundamental shift in market behavior, with more participants choosing physical possession over paper contracts. This indicates growing concern about counterparty risk and a preference for tangible assets during uncertain economic conditions. Historically, only a small percentage of contracts result in physical delivery. Investors should consider how these developments may impact their own portfolio strategies, particularly in terms of exposure to precious metals and other hard assets. The coming months will reveal whether this delivery trend continues and what implications it may have for gold COMEX deliveries and broader financial markets. Experts expect gold to hold near current highs in the short term and remain bullish over the long run. In a 13 July report, Goldman Sachs maintained its forecast that strong structural buying from central banks will push gold to $3,700 per ounce by the end of 2025 and $4,000 by mid-2026. If gold is already flashing warning signals of capital fleeing equities, are we witnessing the early stages of a financial reset? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.